Hey, Bulls and Bears, it is Thursday, January 12th, 2023. And I'm afraid the relief from inflation that we saw here, which is really not relief, we'll talk about that in a few minutes. But even if it is relief, it's too little too late to save the economy. And we're going to talk about that and more. Let's get into it right now, starting right here. And this is the US savings rate. This is how much that people have in their accounts after their monthly expenses, which is dropping all the time. Now, this goes all the way back to the late 1950s. Now, let me go ahead and enlarge it here a little bit. And I'll put myself way up here in the corner out of the way of the chart here. So look to the far right here. This is the savings rate. If you look back, this is the lowest that we've been at since the late 50s. Actually, if this went back further, this may be the lowest in 100 years. We just don't have charts going back that far. They weren't creating too many charts back in the 1940s and early 50s, it looks like. But if you go back to 2008, we saw the drop, which was pretty close to where we're at now, but we're still lower right now. So question is, with today's CPI print being a relief or inflation is easing up a little bit, why is the savings rate continuing to plunge? If people have more money to put back because prices are lower, shouldn't savings rate be increasing is the question. Well, the answer is it seems like it would if people were to save money, but you don't get rewarded for saving money. Let's check the rate on a CD now and see if rates are actually even worth keeping money in the bank. Okay, yields have actually increased some with the increase in the Fed funds rate. We've got Capital One here, annual yield 4.15%, zero minimum deposit. Looks not bad, right? Wells Fargo 1.5% with a $2,500 minimum deposit and a 1-year term. And let's see here, Capital One was also a 1-year term. Chase, look at this, 0.01% annual yield. Who's going to put their money in a CD and tie it up for a year to get that kind of yield? You're basically guaranteed to lose money when you look at the rate of inflation compared to how much you get on your return. Right now, some of the online savings account options have a little bit of a higher yield. 4.5% Bread Savings Bank, Marcus by Goldman Sachs, between 3.7 and 4.4. Of course, Capital One again there. Synchronicity 2.25% and 4.6. Barclays 4.25, 4.35. Citizens 3.3 to 4.25. Amex Savings 0.1% to 4.25. So as you can see, yields are still very, very low. So with yields being so low, it's no surprise that there's not much incentive for people to put their money in a CD or a savings account or a checking account. But the low savings rate is much more than just people choosing to put their money in savings or not. It's much more than that. People are being forced to spend just to keep up with basic needs. And with the levels that we're seeing right now in credit card interest rates, that's why I say this is too little too late as far as the CPI dropping or decelerating. And this is becoming more and more known. I was actually scrolling through some international news today earlier this morning and came up with this. ChinaDaily.com, is the U.S. nearing economic collapse? So the conclusions drawn in this article point to yes, and it talks about a lot of the same things we talk about here in this channel. And you may ask, why is China concerned about the U.S. economy? Because the U.S., we're the number one buyer of all these goods that come out of China, right? So we're the world's largest consumer nation. And an interesting statistic that I always put out there that I don't always do it, but pretty often I like to remind people that the U.S., we're only about 5% of the global population, but yet we consume about 25% of the world's resources. And if we look back over the last couple of years, we see that China is actually looking at a lot of different trade agreements, likely anticipating that, yes, the U.S. Is headed into and is likely already in an economic collapse. Right, so the enormous debt run-up, people think it doesn't have any consequences. Well, it actually destroys trust after a while, because how are these countries supposed to completely trust the U.S. dollar, the world reserve currency, if we could just run up endless amounts of debt? Nothing backing it, no gold, no silver, just unlimited amounts of debt could be created. Well, that's when you have these other countries now also coming into, or integrating rather, gold into their trading agreements with these other countries. And I think what we're starting to see now and what's going to continue to unfold here is going to be something on a biblical proportion. And There's people out there that say we are in the end times now with everything happening. I mean, look, we're on the brink of World War III, it seems like, with all the conflicts, international events happening right now. Consumer confidence, multi-decade lows. People now moving back in with their parents at an unprecedented level. We actually saw the apartment vacancy rate rise to 5.9%, and that puts us back to right at the beginning of the health crisis, and it's likely going to continue. Remember, during the health crisis, a lot of people went out and got their own apartments. They were scared. They were scared they were going to get sick. And that's another area where we're likely going to see some relief, and that's going to be in rents. So rents have dropped now for 4 months in a row. The magnitude of the drop is the biggest that we've seen in 5 years. When we look at September, October, November, and December, the last 4 months of 2022, these were the biggest drops since 2017. So things are starting to happen. It may not seem like it if you're just, what's the word I'm looking for? If you're just casually observing, it may not seem like anything is happening. But I've always said here that this is going to be a slow motion collapse. No stock market crash, no housing market crash, rents are not going to crash, car prices not going to crash, but they are coming down very, very slowly. The Fed's being very, very careful. And you have to ask, if higher interest rates were the solution, then why didn't they just raise rates to 7, 8, 9% right off the bat? Well, people are so leveraged and so far in debt, they know that they couldn't do that. Right? So on one hand, they're pretending that higher rates are the solution that's going to fix this, but on the other hand, they're afraid to raise them too rapidly because all of the debt. But it is all of the debt that made this economy look so good on the way up, and it made even people that had no skills in investing look like geniuses. You would go out and buy a stock and it would go up. Cryptos, people looked like geniuses. They made a lot of money. Now it's not so easy, and people are trying to find the bottom in the stock market, in cryptos as well. And sure, I invest. I look at those things, but I think there's more evidence than not that the whole house of cards is going to be coming down very soon. And that's why, we have to balance investing in financial and business economic news with preparation, because when this entire basically Ponzi scheme economy comes down, if you don't have some resources to survive for a while, it doesn't matter how good of an investor you are. And we're approaching what looks to me like the end game. The lifeblood of the U.S. economy is the U.S. consumer. We're a consumer-based nation, as I mentioned at the beginning of the video. All the goods and products that we consume here in the U.S., the world's largest consumer nation. And that is coming to an end because the consumer, the backbone of the U.S. economy, is approaching the financial edge. These high interest rates and these credit card balances, it's not going to be much longer. And I usually don't say that. I usually say, this could happen in the next 5 years. And I say within 2 years, but I think things are going to start happening this year in 2023. But then again, I look at myself and hear myself saying that, and I'm saying it's actually happening now. Look at the corrections that we're seeing in these assets, right? Home prices coming down, automobile prices coming down. Now rents are dropping, the biggest in 5 years. And what I would say right now, a little bit of strategizing on how to maybe navigate this. If you don't have to buy a house now, don't do it. If you don't have to rent right now, don't do it. If you could live with somebody else, don't do it. I mean, it's not fun having roommates. It's not as fun. Many people would say it's not fun living with relatives. Depends on your relatives, right? They may be fun. They may be partying every night and have a good time. But my point is, if you can save money and move in with somebody and have more cash available when what really hits the fan, you're going to end up being, I think, very happy in the end that you did that. And a little bit of inconvenience now could lead to very big rewards down the road. And take a look at this Bloomberg article talking about falling rents. This article talks about how the vacancy rate is rising and how landlords may be in big, big trouble. And we saw a lot of new landlords come out and invest in homes, especially during the health crisis and beyond. Rental housing is suddenly headed towards a hard landing. That is very, very possible, unless the Fed comes in and cuts rates again. There's not much more loosening they can do with the lending, because now banks have a zero reserve requirement. So there's not much more they can loosen on this lending here. But even with the zero reserve requirement, banks are still, not going to go out and give money to everybody. And it's interesting to see home price weakness at the same time as rental weakness. You would think that more people that are priced out of the housing market and less home sales would equal more people pushed into renting, but it's not happening. Actually, both are falling, rents and home prices both. Right now, onto the CPI number, still much higher than what you're going to get if you put money in a CD. You're still losing money when it is compared to inflation. And the picture right there in this news article looks like NBC shows this woman here holding eggs. And eggs this month are actually way higher than they were last month. This actually looks at December's numbers compared to November, and it shows a deceleration from month to month. But overall, price is still much higher. Right, so falling prices over here, rising prices over there. It's going to be very interesting, and it's going to be fun to try to navigate this if you're prepared, if you're ready for it. If you are not, this could be a very difficult time to try to make it through. And I think a lot of people may not even make it through this. I think we're going to see homelessness surge, even though prices are coming down for housing and rents both. People are just running out of money. Bankruptcies knocking on millions of people's doors. And actually, I was just looking at some medical bills the other day, and just the cost of just basic medical procedures. When I broke my ankle over the summer, a lot of you might remember I did a few videos and I showed you my ankle boot and my little my knee cart where you put your knee on the cart and stroll around. I had to use that for a few months. But I was looking at the bills. If I wouldn't have had insurance, I would have been wiped out. That's how much these emergency rooms and everything else costs. It's just the care and the visits would have wiped me out. So without insurance, it's going to be tough. And people that lose their jobs and don't have insurance and have a medical emergency, look out, because it's going to be bankruptcy faster than you can say affordable health care. All right, so we're going to wrap this one up, folks. Hope everybody liked this report. Please let me know what you think down in the comments. We'll be chatting with you down there. Hopefully talk to everybody very soon. Keep stacking. Big love and peace.